Well, it is now the second week in December, and it is time to start talking about 2026. For properties that are still on the market, if they're not under contract now, most likely they're going to be closing next year, meaning January. Or if a buyer hasn't written an offer yet, unless it's cash or something they can do quickly, we got the holidays coming up. Most likely it's also going to be a January closing. So, where are we sitting currently on a national level? Home prices, we're starting to see them fall in about half of the US metro cities. This is going to be a chart down here that'll show us kind of where that activity is happening. So if we look at annual home values, this is as of September, and this was through realtor.com. So the markets that are seeing the biggest declines: Tampa, Phoenix, Dallas, Miami, San Diego, San Francisco, Vegas, Denver. The pattern is it's cities in the South that saw high growth. We're talking Florida and Texas, and it's cities on the West where you have very high home values. So those markets are the ones that have been seeing the bigger declines. The ones that are still seeing appreciation: Minneapolis, Cleveland, Boston, New York, Chicago. So we're talking the upper Midwest and the East Coast. They're typically older cities and more mature. They didn't have as big of a COVID run up that we saw in the South and the West. And on top of that, they're not building a lot of new inventory. And so you're still fighting over limited inventory. Well, let's start talking about 2026. So this was a webinar I was on last week. So John Burns Research is one of the best housing research firms. They cover not only residential housing, but they also cover the commercial space. And so in their webinar, they were kind of prognosticating what they are forecasting based on their data for next year. So the 5 takeaways were: there is pent-up demand for both rentals and home ownership, but at lower rents and lower home prices than we see today. In other words, people want to rent, they want to buy, but they do want it to be more affordable. In terms of demand, this is headwinds from those buyers and renters that will persist into next year: higher mortgage rates in comparison to the recent past, meaning the last decade; negative consumer sentiment; and U.S. immigration tightening up. Supply headwinds in terms of the product, the housing, that should get a little better next year is apartment completions. In other words, those are going to drop. Now, a lot of those COVID projects have finished. They've already come to the market. And then, of course, unsold new home inventory. That should start to tighten up a little bit. Bullish outlook on the rental market, a little more bullish because they see that the rental market may be a little more bullish than the for sale market. Renters will likely stay longer. And also, there is a growing reserve of future renters that are still living at home. So think of like maybe kids in their 20s staying with mom and dad right now to save the money because of inflation and everything. But when they get more optimistic and they get out into the job market, they're going to rent first. So there's another future wave of renters. And finally, smaller metro areas will outperform the bigger markets. Well, here's a couple charts, easy to see. Poll results of those that they surveyed. Do people think job growth and economic growth will be better or weaker than 2025? 57% say it'll be weaker next year. Definitely a headwind there. Where do they think the 30-year fixed rate mortgage is going to be? Right now, we're sitting about 6.25. These two would be higher. They don't think higher. Most people, 69%, think it'll be lower, but within half a point. So we're, again, 6.25. Maybe we get down to like 5.75, which I think would be fine. We'd be fine at 6. But I know everybody wants 3. Don't expect to see that without major problems. 1 year from now, the national resale home price will most likely be higher, but by less than 5%, or lower, but by less than 5%. They're pretty neck and neck. And I'd say that's telling us most people kind of think the market's going to be flat. Yeah, we'll have some markets go up, some markets go down, but nationally, I expect we'll see a flatter market. Where do we expect market rents to be in bigger apartment complexes? Higher by less than 3%, lower by less than 3%. Again, maybe rents are going up just a tiny amount, maybe like 1% nationally. And then I expect single family home builders next year to build or start, 0.1 to 10% more homes, or 0.1 to 10% fewer homes. They're predicting some modest increase in home building next year. And again, that might help in some markets that have tighter supply. In those southern markets we talked about, they're already oversupplied. with home builders like an Austin market. So I expect we're going to see our home builders maybe slow down a little bit here. All right, this is the eye opener. This is inventory for the past 4 years. So if we look at housing inventory, here's where we sit right now. We're sitting about 12,600 homes on the market. If I go to the peak last year, we were at 13.7. So our December low, if we want to call it that, is almost where we peaked last year. So housing inventory just continues to climb. We're going to need this part, the blue lines, to start picking back up. That is buyer closed sales. Until that blue line starts to come back up. This was pandemic. We won't see that. But if we can get back even to like a 2023 level, that'd be another maybe 500 sales a month. That would help kind of stabilize this inventory from continuing to climb. Because the problem is all these unsold sellers, they're going to come back to the market next year unless they decided to rent it for the next 4 or 5 years. But they're going to come back to the market. They want to sell that property. And so until more buyers can come in and buy those properties, we're still going to have lots of inventory. This is what it's doing to the price. So this is Austin over the last 10 years. Again, pre-pandemic, nice and steady. Very healthy economy. Interest rates were, 4 to 5% in this era. And then they dropped and look what happened. Boom. You just had COVID craziness. Price went way out of line with traditional norms. Again, if we follow that line, I think we're within a year and a half of kind of getting back to this trend. So I think Austin's got probably 1 more year, maybe 2, where we've got to fight this higher inventory, stabilize pricing, and then possibly you can get back to a more balanced market by that time. Interest rates, we've got the Federal Reserve making announcements, I think, this week. So we're going to have a volatile week in the mortgage market. Right now, again, we're about 6.27%, call it 6.25%. VA, FHA, fixed rate loans, you might be at or below 6%. That is good news. If we look at the longer term chart, this was the full year of mortgage rates. So we started the year, look at that, 7.1%. This was in April, we were at 7%. This was in May, late May, we were in 7. So the spring was really slow. And that's one of the reasons we saw that inventory really build up, because you just, buyers want to buy houses, but they don't want to buy at 7%. And so, but finally, this second half of the year, we've really seen rates. Here's 6.5 by the time we got to August. 6.3 in September, 6.2 in November, 6.3. So we're finally down at that 6.25. It's sticking. So we're going to see if that can carry into the spring, because really here's the game right here. If we can start the spring, instead of being at 7%, 7%, 7% each spring, can we be at 6.25? Can we be at 6? That would bring some more buyers out to the market and potentially help start to stabilize that housing inventory game. So if you're a seller right now, just expect we are heading to the holidays. We are now selling properties to 2026 buyers, even in early December. At this point, with contracts, with holidays, with New Year's, all the things, most buyers are going to be asking for January closing dates. If you are a buyer right now, I love this time of year to buy property. Why? Because the sellers know it's about to shrink down on buyer activity for the next 4 to 6 weeks, because we're heading into the holidays. And so you're going to have a lot less competition, and you got plenty of stuff to look at. So, and rates are getting better. So, if you have a budget or time, this is a great time to get out there and write offers. Anyways, hope you guys are planning for the holidays. Should be a nice week here in Austin. If you know anybody looking to buy, sell, invest, or finance, would love the opportunity to chat with you. And of course, make sure to go to our YouTube channel at Ryan Kelly Group. Click that subscribe button. We're close to like 200 followers. We'd love to get a few more. Anyways, hope you guys enjoy your week. Go out and do some Christmas shopping, and talk to you next Monday. Thanks.